Welcome to the podcast that will teach you how to successfully invest in and build steady streams of passive income from the highly lucrative niche of mobile home park investing. Veteran real estate investors Kevin Bupp and Charles Dehart from Mobile Home Park Academy will personally share with you the valuable lessons they've learned along their journey as mobile home park investors, so that you too can learn how to build massive cash flow and huge profits from this extremely lucrative niche. So without further ado, let's welcome your hosts for today's show, Kevin Bupp and Charles Dehart.
Welcome, guys and gals, to the Mobile Home Park Investing Weekly Podcast. We'll provide all the information that you need to know to successfully locate, negotiate, close on, and make huge profits from the lucrative niche of mobile home park investing. I'm your host, Kevin Bupp, and in today's show, we're going to be speaking with MAI appraiser and manufactured housing expert, Eric Hansen. Now, Eric is Executive Vice President of Midwest Appraisal Group, a real estate appraisal and consulting firm with offices in La Crosse and Madison, Wisconsin. He has been appraising a variety of commercial, retail, and industrial properties since 2002, but specializes in mobile home parks, franchise hotels, and convenience stores. Eric earned the prestigious MAI designation from the Appraisal Institute in 2014 and currently serves on the board of directors as vice president and educational chair for the Wisconsin chapter of the Appraisal Institute. Now, and in case you guys weren't aware, we actually had Eric back on the show. It was way back, episode number 26, so probably going on 2 years now. So be sure to go and check that out. Again, episode number 26. Now, my goal with the show today is not only to cover the appraisal side of the MHP space, but more importantly, we're going to be diving into things like industry trends, cap rates, rental trends that Eric is seeing, what kind of sales activity that he's been noticing in the marketplace, as well as his perspective as to what direction he really sees this industry heading over the coming years. Again, if he had a crystal ball, where does he see this thing going? Additionally, Eric promised that he's going to share some fun and humorous mobile home park related stories as well from his time within this industry. So I'm real excited to have a candid conversation with Eric about a variety of industry related topics. But before we get on to it, guys, just have an exciting announcement that I'd like to share with you real quick. For those that have been listening into the show for a few years now, then you'll know that I used to offer a free 30-minute phone call or consultation for those that are interested in learning more about the mobile home park investment niche. Well, I got some great news. I'm going to start that up again, okay? I have been doing it for probably over a year now. So what's going to happen is every Friday, I'm going to make myself available for 4 different 30-minute time slots to discuss anything your heart desires regarding mobile home park investing. However, there is one caveat I'd like to mention. We're going to be conducting this call via Zoom, and so you will need to have a camera available as well as a decent mic. And it doesn't have to be an elaborate mic like we use. It could just be a USB headset or even a standard iPhone, one of the headphone mic combos that come with the iPhones. Something along those lines. It just can't be the built-in microphone in your laptop because those sound like crap. So I'm going to be recording these calls and I'm going to be releasing them as educational content, okay? Now, I'm going to tell you not to worry because I know a lot of you, that makes you nervous thinking about I'm going to be recording it. Now, there's no such thing as a stupid question, okay? And the best part is that our conversation together, it's going to benefit thousands of others who are probably dealing with the same exact challenges that you might be having. So you can really think of it as our way together, you and I, of giving back, right? To giving back to others that are interested in this space. Now, I promise you it's going to be a lot of fun, and I really do look forward to speaking with each and every one of you. Now, in order to schedule this call, go over to my website, kevinbupp.com, and just scroll down 3/4 of the way on the right-hand side. Look for the button that says Schedule a Call with Kevin. Go ahead and click on that. It'll take you to my calendar link. Now, when scheduling this call, be sure to provide clear and concise details on what you'd like to speak about or what questions you have for me during our time together. You'll be surprised at how fast 30 minutes really goes, okay? So make sure that you include all those details so that I can better prepare for our call and it can be spent efficiently together. Now, remember, have your camera set and your mic ready to go. It doesn't have to be an elaborate setup. A standard built-in, laptop camera and also a USB headset. They're like $20 or even iPhone headphones or probably Android headphones as well, the ones that have the built-in microphone. If you show up without video or you haven't provided your questions in advance, I'm going to be forced to go into the other calls, okay? So if you want to enjoy this time together and take advantage of it, please be prepared. Again, schedule the call by going to kevinbupp.com and clicking on the Schedule a Call with Kevin button, which is 3/4 of the way down on the right-hand side of the page. All right, that's all I have, guys. So without further ado, I'd like to welcome our guest for today's show, Eric Hansen. Eric, what's new, my friend?
Hey, Kevin, how are you today?
Oh, I'm doing great, bud. I appreciate you joining us here. Very much looking forward to getting you back on the horn. It's been a couple of years I believe going on two. I lose track of time. I can't remember.
Yeah, I do too. I checked back. It has been a couple years now, and I appreciate the chance to come back on and give a little insight on what I've seen. I see some of the same things and a lot of different things now too in the last couple of years. So I'm excited to kind of dive into some of those and maybe answer any questions you might have too, because I'm sure you guys see a lot of appraisals, good, bad, and otherwise, and probably don't always understand what's going on with those.
Yeah, no, exactly. And so I could obviously eloquently speak from a perspective of an owner and an investor, but obviously you guys take it from a different side of the table. And so, we've been seeing trends such as a lot more competition in our space, cap rates compressing. I mean, I think that's the general theme of basically any type of investment real estate today. It doesn't mean just mobile home parks, but all those patterns are kind of filtering into our space, and lots more buyers out there, than what I saw 2 years ago, maybe when we last had our conversation. And just, pricing is much more competitive and many more folks bidding on these things than what would have been in the past, and people kind of pushing out their, I guess their parameters as far as, maybe they were looking for particular MSAs and then they got open to secondary markets. And now those same folks are very open to tertiary markets when, a couple of years back they might not have been. And so I guess what I'd love to do, Eric, is at least first ask you, what have you been up to since we last talked? So 2 years have gone by. I'm sure you've done lots of appraisals since that period of time. Has anything changed in your business? I mean, is this I'm assuming still your core focus, right? Mobile home parks.
Yeah, this is still my core focus. I would say now more than 2 years ago, I'm appraising and consulting on more and more parks. It's not 100% of my business yet, but it's getting close, which I really enjoy. In the last probably year or two, I've done work in about seven states in the upper Midwest. That's kind of our core area. And we do some other property types in Minnesota, Iowa, and Wisconsin. And then I branch out a little farther for the manufactured home communities. I've appraised parks ranging in size from about 10 sites, which was actually a challenge being that small, up to close to 500 sites, and values up to over 20 million, from a couple $100,000 up to 20 million. So kind of a wide variety of properties and different makeup. So we do appraisals for the most part for bank financing. That's kind of what everybody assumes we do: buying, selling, refinancing, that type of thing. We also do some stuff to settle estates, divorces. There's been some sale leaseback things we've gotten involved in. So a few of those things too, as well as the traditional lending side of it.
Okay. I guess probably 5 or 10 years ago, when how many years have you been in appraising parks again? What was the year that you really got your start?
About 2012.
Okay, so you've been at it now for 5 years, or I guess 6 years now, 6 or 7 years. Sorry, my math is really bad. I couldn't even add that quick. No. In any event, tell me about what you've noticed as far as the difference of buyer types, or I guess new buyers coming to the space. I bet you 5 years ago, you probably saw a common theme, a lot of the same buyer groups, right? Buying in certain regions. Whereas today, are you noticing lots of names that you haven't seen before?
Absolutely. I really am. And a lot of the names that have been around and are bigger operators now, but a ton of new people or that are either in the industry or trying to get into the industry. I get a lot of questions on my LinkedIn account, or want to get started in this industry, where's a good place to start? Or, a lot of times, what's for sale, that type of stuff. We get that question a lot. A lot of new people coming in from, maybe single family people, or apartment people, a lot of different asset classes, and some people that have zero investment experience coming in. Just they think it sounds like a cool industry, and little do they know how tough it is. But yeah, a lot of new people in the industry. We've done a lot of work in the past couple years for people that are on their first, second, third, fourth part, kind of getting that ball rolling. And I've seen, and you probably would agree with this, that the first one is kind of the hardest one to get across the finish line. And once you get that ball rolling a little bit and get a little experience, it doesn't necessarily get easier, but maybe it makes a little more sense once you've got that first one going a little bit.
Yeah, I think with anything, it's always hard to get that first one done, right? You get the first one done, builds the momentum a little bit, and kind of takes some of that initial fear away. And hopefully, that first one actually was successful, right? Now
Right.
If you lost your butt on the first one, then the second one might not ever come. But
yeah, exactly. Yeah, and hopefully they are successful because that keeps us busy too. So.
Have you noticed that some of the older buyers, I guess not the older buyers, but the groups that have been around longer, do you notice that they're picking up their buying activity, or do you see maybe the opposite trend where the folks that have been in the space a really long time are kind of holding steady, being cautious buyers, and now you got all these new groups coming in being a lot more aggressive with their purchasing criteria? Are you seeing anything like that happen?
I would agree with that 100%. Some of the existing buyers that we worked for, 5 years ago, 6 years ago, they have slowed down a little bit. They're still buying some stuff, but it seems like it's not necessarily the big turnaround projects. There's some of that, but not as much as we used to see.
Mm-hmm.
But definitely the new buyers are far more aggressive. I don't know if that's a good thing or not, but it seems like they are really willing to pay those low cap rates and maybe buy in an area that doesn't make a whole lot of sense. And the more seasoned operators seem to a little bit stick in kind of the traditional MSAs that they like to be in and that sort of thing.
Can you quantify maybe a little bit of when you say maybe areas that might not make as much sense? What do you mean by that?
Maybe like a small area that has a ton of vacancies and it's really that is a market vacancy, and we'll get into that maybe a little bit later on different vacancy types, but maybe it's a small area that is 50% vacant, and that's just the market. There really just isn't a ton of demand there. Now there's other small areas in, like Iowa, for example, that have really good occupancy, even though they're a small market. So we see a little bit of that where those small towns that aren't necessarily the best investments, people are going after those. And I think a lot of it is the supply side is so small right now for anything that's out on the market that people just tend to gobble up whatever they can find.
How about, one of the interesting trends that I've seen, in fact, that one that we've even been a lot more open to over the recent, I guess, year or two is the infill opportunity, right? Buying a park that's got maybe a significant amount of vacant pads that are fully developed that has an opportunity for us to bring new homes in. I feel like maybe, 5, 6, 7 years ago when we started dabbling in this space that people avoided those types of parks like the plague. Whereas today, they're realizing the opportunity that's there, especially with programs like the Cash program. I know Legacy has a program, Cavco has a program, a bunch of different programs that really assist park owners and operators in providing financing or, opportunities for them to bring these new homes in that 7 years ago might not have been possible because it was too capital intensive to go out there and buy, 20 brand new homes cash. So can you speak to that a little bit? Do you see the same things that I'm seeing as far as the desirability of those types of highly vacant parks? People are gobbling those things up like Skittles, whereas they might have been avoiding them before.
Yeah, I would say so. I see a lot of operators on the Cash program in particular. They really like that. Gives them the ability to infill. And the other thing, that we need to mention is it makes your park look so much nicer when you bring all these brand new homes in. But yeah, I would say that's definitely a trend. Obviously, operators still want to sell homes, but we're seeing more operators that will rent homes if they have the opportunity. They might bring in 10 or 20 homes and sell a few and then rent some until they get the opportunity to sell those. And it seems like it's a little more accepted now on the park-owned home side, especially on the newer homes. The older homes is still kind of hit or miss, but the newer homes, it seems like if they can't get them sold, they're willing to rent now.
But from an appraisal perspective, you're still only looking at those, even if they're new homes, as an actual piece of personal property, like that's got a chattel value to it, and the park's being underwritten on the lot rent component only. Is that correct?
Yep, that's generally the case. There's a few lenders that have asked us to include some park-owned homes, and usually they're older, not a ton of value there. But in general, we are focused on the lot rent potential. So we look at what's actually occupied economically, not just physically. So they've got either tenants or rent credit, whatever the situation is, occupying those sites. So that's how we look at it. Now, a park that has a significant number of park-owned homes or rent credit homes or straight rentals, versus one that is all owner occupied, it tends to be a little bit higher cap rate. There's more risks there. So we're going to look at a higher cap rate and possibly a higher vacancy rate too. You have the turnover with the rentals and also some of the park-owned homes and rent credits. You'll have some turnover there. So we need to consider those things where if it's all tenant-owned homes, probably not as significant on the vacancy side.
Now, how do you look at the ones that have like the 21st program in place? I mean, folks that are only putting 5 and 10% down, do you apply a higher cap rate, higher risk profile to those types of communities? Let's say it's a 100 space community, 40 of the homes in there are from the 21st mortgage cash program, park owners guaranteeing those. But obviously we know that there's a high default rate when folks only have to put a 5 or 10% downstroke in the game. I think it's inevitable that the default rate is going to be high in that program. I've seen it play out already. So do you put a different risk profile in those types of communities that have a lot of cash programs or a lot of cash homes in there?
Yeah, absolutely.
Okay.
You have to, because that turnover is there, and it's more risk to the owner. And somebody buying that community with half cash homes, they inherit that risk. So there has to be some consideration there.
Okay.
I can't put an exact number on it, but
that's fine.
Consider that.
Okay. I know one of the things you mentioned before we jumped onto this call here is some of the different trends that you've seen happening, maybe in more tertiary or rural markets with regards to submetering utilities, private utilities, and actually creating a profit center out of that. Maybe you could speak to that a little bit, because I think that was very intriguing.
Yeah, we've seen that, in a lot of the states we work in, where they'll have private well, private septic, and they'll actually start submetering the homes and billing back. And some of the operators will base it on what local municipalities bill for their water sewer. So it's kind of a consistent rate, and they apply that to their homes. Now, we also talked about the legalities of that, and we as appraisers don't necessarily dive into that part of it. We assume if it's a credible operator and they're doing this, that's legal in whatever state they're operating in.
Yeah. So guys, be sure to, just to that point there, be sure to check the legality of this. If you're about to do it in the park you own, make sure that it's actually legally allowed. I've seen some states or some municipalities that have some underlying requirements that you be a utility provider, which is a completely different license. So you got to be a licensed utility provider in order to actually even bill back. And I've seen other instances where you can bill back, but it can't be a profit margin. You have to be able to justify the costs associated with the well operations or the cost to upkeep the septics. And so just do your research. And then on the flip side of that, if you're looking to buy a park that's got, those types of profit centers underwritten into them, confirm that it's legal, that you don't take this park over, you bought on that revenue stream, and that revenue stream goes away, and maybe on top of that, you get a fine slapped or imposed on you.
Right.
Yeah, that wouldn't be a fun situation. So just dive a little deeper into that and see if that might be an opportunity for you. I know that in two of the communities that we own, in Maryland, I was telling Eric this, that we're on septic and private well, and we just recently submeters those parks, not with the intent of necessarily, at least not today, with the intent of billing back for usage, but more importantly to really identify who the violators and the abusers are that are wasting a lot of water. Because ultimately, when you've got someone that leaves their faucet on or they've got a leaky toilet, it's like death to a septic system getting overloaded. And so we want to basically salvage our septics that are there, and we want to basically identify those abusers and take care of it accordingly, so that we're not replacing leach fields or septic systems on a regular basis. So that's why we're doing it there. One of the other things you mentioned, Eric, that I thought was quite intriguing. If you got into this business 5 years ago, one of the common themes was, stay away from private utilities or only buy a park that's got city water and city sewer. And while that is the preference, I think, for just about anybody, we'd always rather have city utilities than private utilities for the most part. We've never been opposed to private utilities as long as you understand what's there, what's at hand, the risk associated with it, and do your proper due diligence. But I know you had made a mention that it just generally speaking, it's becoming much more acceptable for buyers, even buyers that were very black and white, like only public utilities. Now they're kind of coming on over to the dark side. They're a little more accepting of private utilities. Yeah,
that's a good way to put it. We're definitely seeing that, especially on private water. That doesn't seem to be a deterrent anymore. And a lot of that is, the cost to drill wells is generally not significant in most areas if you have decent soil and a decent water table. probably still a little hesitation on some types of private sewer. Generally people still don't want the packaging plants and that sort of thing. But the septic systems are becoming more acceptable too, depending on the structure and how many, things like that. We'll see cases where there'll be a private septic system for every 2 homes. So you got 50 in a park. That's a pretty big responsibility if those start to go bad, where maybe it's better to have 1 or 2 systems for the whole park to be able to maintain. But yeah, in general, the private utilities becoming more acceptable.
Yeah, got it. And how do you adjust for risk or for pricing or value, I guess is the best way to put it, when take 2 parks that are literally maybe in the same area, same MSA, one's on public utilities, one's on private. Are there adjustments made due to the fact that one's got private utilities?
Generally, if all of the things are equal, that's going to be built into the cap rate that investor paid. So when we verify sales, some of the sales, it's stuff we've appraised, so we know everything about it and based on how that investor looked at it. But if it's stuff we're not real familiar with, we'll try to contact the buyer or seller and see how that sale went together and see what their thoughts were on either public or private, and if that really made a difference. And sometimes it doesn't. They might say, no, that the well didn't concern us, so we didn't really adjust the cap rate, and that's what we're going to pay for it. Okay. So, there is market data that will show a difference, and generally private will be a little higher cap rate than public utilities.
Got it. There was an example, and I don't recall exactly what the example was of maybe a park in South Dakota somewhere that had some extreme costs. Can we speak to that a little bit since we're on the topic of utilities?
Yeah, we looked at a park out in South Dakota, and this park was right at the metro line, the city line, so it was actually in a township. And the park, they actually attempted to annex into the city, and the city didn't want them because the sewer in that area was not up to additional capacity. So they were kind of stuck with the township sewer. And the cost to the owner was paying water and sewer expense at that time, was running about $150 a month per site.
Wow.
And I talked to the owner. The owner's son was a civil engineer, so he knew everything about the structure of the park. And he said, they've tested, there's no leaks. That's just what the bill is. And they went back to the township and renegotiated a lower rate, but was still very, very high. Just to give you an example, the other parks in the city were running probably $40 to $50 a month per site for water sewer, and this was about $150.
Wow.
So how we look at that, obviously on the expense side in the income, but we also look at it from a rental side. If the rents are exactly the same, but one tenant's got to pay $150, one tenant's got to pay $40 in addition to rent, you have to consider that, especially if there's vacant sites in both parks.
Yep. Got it. Very interesting. So how much of a reduction were they able to negotiate? Was it significant or not so much?
I want to say it was about 25%. I don't have the notes right in front of me,
I guess.
But it was better than nothing. But still, it would have been, if they were able to annex and pay additional real estate taxes, it would have been far cheaper to do that than to continue to pay those township sewer costs.
Got it. Let's talk about some of the trends that you're seeing with regards to market rents. I mean, I still am a firm believer, and I'd love a debate on this if there is one. I don't think there is, because I think you'll probably be on the same page. But just regarding, lot rents across the country, I still personally feel like if we're generally speaking about our industry, mobile home parks, that lot rents on average, and there's some, markets that don't necessarily apply to this, but for the most part, they're below where they probably should be. And I think a lot of it has to do with just, this being very much a fragmented industry, lots of mom and pops in this space that I've seen many markets, I'm sure you have as well, where it's dominated by all mom and pop operators that have owned for 40 plus years. There's not one professional operator in that space, and everyone just literally hasn't raised rents. They all look at each other. Well, Tommy's not raising rents this year, and Billy didn't raise rents this year, and I guess we're not going to raise rents either. And you go in there, and median home prices are $180,000, and their lot rents are $150 a month. I've seen many markets like that. I'd love to get a sense from you as to what really do you think, how much room is there really to run as far as market lot rents? I mean, just industry as a whole, based on your outsider's perspective looking in, and being that you're obviously an appraiser.
Sure. 5-6 years ago, it was common to see lot rents in the the mid 100s in the upper Midwest, 150, 160.
Wow.
Yeah, it's crazy. Those days are gone. It's hard to find things below 200 now, plus water and sewer on top of that. In general, lot rents have gone up in all the markets we work in. Still zero consistency, none whatsoever. And you touched on it, still a lot of the mom and pop owners, and you'll have larger operators in the same towns, and their rents will be $150 difference. Sometimes the larger operator has zero amenities, so they're basically the same park, and there's just this huge lot rent difference. So part of what we need to do is try to justify that. Why is this park $450 and this one's $300? Is that the market, or is it just the operator? Sure. And most times it's just the operator. In general, I would say the larger operators, the Sun Communities, those type of groups, the big REITs, they're generally $50 to $100 more than everybody else in the different markets, or higher. Usually they have some different amenities. They'll have a clubhouse with an on-site manager, maybe a swimming pool, something, above and beyond what the normal park has. So there is a little bit of justification for that higher rent. I think the biggest is the on-site manager that's there full-time, handles any concerns, usually an on-site maintenance person that's there for full-time. So there is some value in having those people there and passing that through on the rental side. I would say in general, a lot of places in the Midwest are $10 to $25 increases every year. That seems to be kind of the general consensus. Some are a little bit higher. We still see some that do it $3 or $4, real minimal. But yeah, kind of that $10 to $25 is the range we see. I'll give you a specific example. Sometimes I like to say that manufactured housing doesn't follow the typical trends of real estate. And what I mean by that is, you have a smaller market, you assume that prices and values are smaller than a larger metro. I did some work out in North Dakota, out in Minot, this couple months ago. Minot's got a population of about 48,000. Their rents out there are in the low to upper 400s, including water and sewer. And then if you shoot down to Sioux Falls in South Dakota, population of 184,000, so basically 4 times as big as Minot, rents are in the low to mid 3s plus water sewer. So when you adjust, the rents are basically the same in both markets, but you have one market that's 4 times as large as the other market. So it doesn't fit the traditional real estate thought process there. So kind of interesting there. The other interesting thing was the housing. Average housing in Minot was about 228,000, and Sioux Falls is about 180,000. So a little bit of a difference there. And Minot, if you look at it on a map, is just kind of in the middle of nowhere, but they've got a good economy, big Air Force base there. Everybody within 100 to 200 miles comes there to do all their shopping and all their other, goods and services. So there's a lot of demand in that area, despite the population. So going back to our typical, what investors look for, the MSA of 100,000, things like that, Minot doesn't fit that criteria, but it's a really strong market and really low vacancies out there. So kind of a little curveball there.
Got it. That's interesting. Have you seen any trends with new parks being developed? Have you been involved in any appraisals on, or either maybe new parks being developed or even expansions of existing parks?
Yeah, I have not been in any brand new parks being developed. I've heard of some down south. I think there was a big one in Louisiana that was recently completed or under construction. That's kind of out of our market, so we didn't go down there for that one. We have seen there's been different parks. I think there was one in the south side of Des Moines that was doing a big addition. Traverse City, Michigan, there was a large operator that was putting a massive addition on. There was one recently in Battle Creek, Michigan, putting an addition on. Yeah, so that's definitely happening. I think more of the addition than the new construction. And I think some of that is, you always have the battle with the municipality that doesn't want the mobile home park.
Right.
I think if you're already there and established, okay, what's another 20 homes on that site? I think that's how they kind of work that angle a little bit, but definitely demand in all those markets I mentioned for new homes and just affordable housing in general.
Got it. Do you assess any type of risk when doing appraisals? I mean, have you done any appraisals in markets where there's rent control present? And if so, Is there additional risk associated with that from a value perspective?
The first question, no. We have not done anything with rent controls. So I can't really answer the second question. I'm not sure how investors look at it. My own perspective would be, I would think there's got to be some risk, because if you got to go through the procedures every year to raise your rents, that's probably a hard thing to do and justify a rent raise to the county commissioner or whoever it is. And they probably already don't like you because you own a mobile home park.
Right.
And here, let's try to reduce some of our expenses or raise our rents a little bit. They're probably not going to go along with it. So just my take.
Got it. Fair enough. Well, so you've been in the space, you've seen a lot. I'd love to maybe end this interview on a more comedic side of things, and maybe share one of your maybe top one or two stories that you could enlighten us with here. And it could be maybe comedy, maybe horror. I mean, you go ahead. I'll let you take the mic and run with it. But if you would, maybe share some stories from your time in the business.
Yeah, I got a couple stories. One relates back to Minot out in North Dakota. Back in, I think it was 2011, they had a massive flood there. And actually, several of the parks in town were affected. So I had done some research, and I knew about this flood before I even went out there. And a couple of the rent comparables I used, they were older parks, smaller sites, but they were all basically brand new. They had hauled in all new homes after the floods had went through. So you're driving around and it just doesn't fit what you would expect that older area to look like, because it's all brand new homes. And actually, one of the parks out there is right in the middle of where the flood control project is going to go. So there's going to probably be some eminent domain issues to deal with there. After the owner had already refilled the park with brand new homes, now they're going to probably look at some type of condemnation. Not sure exactly how that will affect them, but there will be some effect there.
I actually spoke with a few park owners. One guy that owned two communities there in Minot that both had his parks affected, where it wiped out all the homes. So I actually know a little bit about that story. It's quite catastrophic. Yeah, it's interesting.
Yeah, but in the meantime, they've done some flood control and put some dikes in place and things like that. And it's a major, probably 10, 20-year project to get everything straightened out there. But kind of interesting. So you don't expect that going in there. Another interesting story, I get a lot of phone calls about bad appraisals, just kind of comes with the territory. A friend of mine has a park in Michigan, and he bought it a few years ago. It's maybe 50 sites, and it was kind of a train wreck, the classic turnaround. Junk homes, vacant sites, low rents, a lot of cleanup. And he spent several years doing all this stuff and got it back to where it was basically stabilized. I think he's maybe 90% occupied now. Got it cleaned up, new homes, all that sort of stuff. So they went to get it reappraised, and the bank hired the guy that had lived in the county his entire life and knew everything. And he basically appraised it for basically what the guy paid for it before he did all that work. It's like I read through the appraisal, and the two things that the guy did that were big errors. He basically used a percentage expense. He didn't itemize each expense. So he looked back at the historicals during the cleanup period. Yeah. They were running maybe 70%, say. So he just said, well, here's rents and chop off 70% and then cap that. So his value was way off. The other thing he did, he had sales of just about every property type except mobile home parks, and pulled some cap rates from those. So you had a really high cap rate, and the whole valuation was just completely skewed, and it's probably half of what the property was actually worth. So, in that situation, maybe it doesn't make a big difference, but what we've seen is somebody's going to pull some equity from that park to buy another park. Now you have two deals messed up because someone was incompetent and just tried to piecemeal something together. So that was another story that I saw there.
In that situation there, what do you do? Does that borrower dispute the appraisal with the bank, and what does that process look like as far as will the bank did they order a new appraisal through you or through someone else? Or
in that situation, they didn't. And I think he was just trying to renew his original loan. So he wasn't going to cash out anything. So it got his loan done for that situation. But yes, we've seen situations where the lender will call somebody else and kind of come in and give a second opinion and figure something out. Yeah, we see that once in a while.
Good deal. Good deal. Well, I'd like to switch gears a little bit here, and we're going to work on wrapping up the show, Eric. And you've obviously shared a lot of great information here today. It's always a pleasure having you on the show. I'm glad you're able to come back and join us. And if you had any final words of wisdom, I call it the mobile home park words of wisdom, that you could provide to any newer aspiring park investors that may motivate and inspire them as they progress in their mobile home park investing career, what would those final words of wisdom be?
Yeah, I would advise it's going to go a lot slower than you would expect. We hear a lot of times on some of the forums and things that we're going to buy 5,000 sites in the next 2 years and we're brand new investors. Probably not going to happen. You need to build your network first with park owners and people that are in the industry. When you first start out, the brokers aren't going to call you back. They're too busy to waste their time on somebody that has no experience. You got to buy a couple parks on your own first before the brokers are going to even consider you. Get your track record kind of in order before you start reaching out there. And I don't blame the brokers at all. They have serious investors they work with. They don't like to waste their time or the property owner's time. So my advice, again, is just take your time. It's going to go slow. Get over that first park. Get that first park and get some experience there before you try to take over the whole industry.
Yeah, speaking to that 5,000 lots, the very aggressive goal, and I love big goals, right? The big, hairy, audacious goals are awesome. But one of the challenges with this industry is actually being able to deploy that much capital into the space. If you start talking about buying multifamily apartments and you want to acquire 5,000 doors, very much realistic. And it's realistic within the mobile home park space as well. It's just you got to understand that there's not as much inventory out there to pick from. And the deal sizes aren't nearly as large. And the average apartment complex, while that might be 250 or 300 doors, that's surely not the case in the mobile home park space. You're probably going to have the opportunity to purchase more along the lines of 100 unit park, 100 lot size parks versus the 300 and 400 lot size parks. Although the larger ones exist, they're not as readily available as you might find in like the multifamily apartment space. So I don't know if you notice the same thing or agree with me on that, Eric.
Yeah, absolutely. It's hard to go big in this industry. It takes some time. And yeah, generally when apartments sell, they're fairly big complexes, so you can acquire more units. Another thing I'd like to add, Kevin, is I see a lot of the marketing flyers that people send out. And for the record, I have not seen yours. I would advise to get creative with those. I see some that are so boring. It's literally like typewriter font, I want to buy your park, call me. Tell your story. Tell the story of who you are, what you're trying to accomplish. Maybe put a picture in there, something like that, something to appeal to that owner. And we see when we go out to appraise a park, maybe for a refinance, the owner will hand us a stack of these cards. Here's all these flyers. Everybody wants to buy my park. And you look through them and you kind of laugh. Just get creative with that and send a personal message. That'll get you a lot farther.
I can't believe you haven't seen ours yet. I think we've probably been mailing to every owner in the U.S. for the past.
I must be in the wrong areas. I don't know. But
yeah, that's funny. Well, good deal. Well, Eric, it's been an absolute pleasure having you here. And for folks, if you'd like to learn more about Eric and his company, you can go visit his website, MidwestAppraisalGroup.com. You can reach out to him via email, Eric, and that's ERIK at MidwestAppraisalGroup.com, or even reach out to him via phone, 608-279-1164. And we'll be sure to place all that information in the show notes as well. And Eric, I just really want to thank you again for joining us here today. It's been an absolute pleasure, my friend.
Yeah, thanks, Kevin. I really appreciate coming back on here, and I'm happy to talk to anyone in the industry. If you want to give me a call and just chat, happy to do that.
Okay. Guys, that's all we have for today's episode. Before we say goodbye, just want to remind you of the free gift that we give all listeners who take the time to go over to iTunes and leave a review and rating. We'll give you the exact cold call script that we use in our very own business. As Eric had mentioned, a lot of people do direct mailing. We do as well, but we also do outbound cold calling, which is another great form of direct-to-owner marketing. And so if you'd really like to take your business to the next level and get that first deal done or that 10th deal, whatever deal it might be, you definitely need to be utilizing outbound cold calling into your business. Now, what you need to do to redeem that free gift is go over to iTunes, leave that review, and then send an email to gift@mobilehomeparkacademy.com. Just tell us who you are and what screen name that you use to write the review, and we'll go ahead and respond back with a email with the attachment of that cold call script. You can also stop by our website, mobilehomeparkacademy.com. You can listen to all the podcast episodes that we have. I think we were on episode 105 or 106 by now. So many, many hours of free content available to you. In addition, you can download a copy of our free ebook, which is the 21 biggest mistakes investors make when purchasing their first mobile home park and how to avoid them. It's an absolute read. It's a short book. Whether you're brand new or you own 10 or 100 parks, it doesn't matter. I'm sure that you'll be able to gain some information from that free report. And so, guys, just want to thank you again for stopping by and joining us here at the Mobile Home Park Investing Podcast. This is your host, Kevin Bupp, signing off.
Congratulations for taking the necessary steps to achieving massive success through the highly lucrative niche of mobile home park investing. Be sure to visit our website, mobilehomeparkacademy.com, to download your free digital ebook version of the 21 biggest mistakes investors make when buying their first mobile home park and how you can avoid them. And while you're there, be sure to subscribe to our free monthly mobile home park investing newsletter, which is jammed full of valuable tips, tricks, and strategies to help you accelerate your path to success as a mobile home park investor. More information about this podcast and its hosts can be found by visiting mobilehomeparkacademy.com.